think of a mortgage loan as a three-legged stool. Each leg has to be there or the stool will fall, right? The legs are credit, income, and assets. And I say it like that because you can't have really good credit, really good assets, and no income, right? You can't have really good assets, really good income, and no credit, right? All three of those things need to exist. Really what it's about, it's credit, income, and assets. And then depending upon your comfort level, you can dive deeper into each one of those. Like what kind of income do you have? On the credit side, have you had a bankruptcy, in the last couple of years? Because that would be important. Because I've actually done loans, or haven't done loans, but I've talked to people where their credit scores were fine, but they had a bankruptcy 2 years ago and it's, whatever reason, recovered enough where that it was in the mid 600s where you technically could get a mortgage for it. But because of the timing of when that bankruptcy happened, you couldn't, depending upon, the FHA conventional, there's different guidelines for bankruptcies, but it's a good example of the credit question, right? Because usually people have a fair idea of where they are, because ultimately what you're asking is, whether they know it or not, is, do you pay your bills, right, on time, right? And most people know that if they do or they don't. And I think that it's incumbent on realtors to really have that conversation before you spend too much time with them showing houses, because those can be deal breakers right off the bat, and you need to know that.